Welcome to Dhanda the Great Academy's Forex Trading Guide. In this video, we'll introduce you to the fundamentals of technical analysis, a powerful tool that traders use to make informed investment decisions. Technical analysis is all about studying past market data to forecast future price movements. Unlike fundamental analysis, which focuses on economic and political factors, technical analysis looks directly at price trends and patterns. Let's explore the three main types of charts. Line charts, simple yet effective for identifying overall trends. Bar charts, provide details like opening, closing, high and low prices. Candlestick charts, a powerful visual tool that highlights market sentiment with color-coded bars for rising and falling prices. Candlestick patterns are crucial for spotting market reversals and continuations. For example, an engulfing pattern indicates a strong market reversal. A hammer signals a bullish reversal after a downtrend, and the famous doji represents market indecision, often signaling potential trend changes. Traders focus on trends to make strategic decisions. Uptrend, bullish, when prices consistently hit higher highs. Downtrend, bearish, when prices are making lower lows, and when prices move sideways, it's called a trading range, often a period of consolidation before a breakout. Chart patterns like symmetrical triangles, double tops, and head and shoulders are essential tools. They help traders spot potential breakouts and reversals, enabling precise entry and exit points. The Fibonacci sequence is more than just numbers. It's a vital tool in trading. By using Fibonacci retracement levels, traders can predict potential support and resistance zones, optimizing their entry and exit strategies. Indicators are crucial for analyzing market momentum and volatility. Moving averages smooth out price data to identify trends. MACD and RSI are popular for spotting momentum shifts. Bollinger Bands measure market volatility, helping traders identify overbought or oversold conditions. Advanced traders often use the Elliott Wave Theory to identify long-term market cycles. And with pivot points, you can forecast key levels where price reversals might occur, guiding your trading strategy. Choosing the right time frame is crucial. Long-term traders use daily or weekly charts. Swing traders focus on hourly to 4-hour charts. And day traders prefer minute charts for quick trades. Aligning your strategy with the right time frame can enhance your trading success. Thank you for watching. This was a glimpse into the world of technical analysis. For more in-depth guides, trading signals and courses, visit our website at www.dhandathegreat.com. Don't forget to subscribe and follow us for more trading insights.